Tonight, I am going to say something that may feel uncomfortable, especially for anyone who has watched a biotech investment swing from absolute conviction to disbelief in a matter of hours. How does a company that achieved one of the rarest milestones in oncology, the first T cell therapy ever approved for a solid tumor cancer, fall to a price barely above $2? How does a scientific breakthrough turn into lawsuits, operational doubts, credibility questions, and a guidance cut so sharp it erased nearly half the company's value in a single day? And how does a stock that once touched a multi-billion-dollar dream become something investors now approach with caution and a quiet hope that maybe the story is not finished? Before we go deeper, a quick message for those watching on Shorts. If you are on Shorts right now, tap the full version link below so you can hear the entire story without interruptions. And for everyone else, stay with me to the end because a full trading strategy based on the current setup is included later. So do not miss that part. To understand Iovance Biotherapeutics, ticker IOVA, we need to reconstruct the full narrative arc that shaped how the market thinks about this stock. Biotech investors do not simply trade revenue or trial results. They trade the direction of the story. And this story has moved from breakthrough to turbulence, from euphoria to shock, from litigation to recalibration, and now into a fragile but active attempt at rebuilding. The scientific foundation began more than a decade ago at the National Cancer Institute. By the early 2010s, tumor-infiltrating lymphocyte therapy, known as TIL therapy, had reached a stage where it was medically promising but operationally demanding. Unlike standard oncology drugs that are mass-produced and administered in predictable cycles, TIL therapy requires extracting a patient's own immune cells from their tumor, expanding those cells outside the body, and then reinfusing them as a personalized treatment. Under normal conditions, a therapy this complex develops slowly through years of refinement and cautious scaling. Iovance did not follow that path. The company aggressively advanced programs like LN-144 for melanoma and LN-145 for lung cancer while preparing commercial-scale manufacturing. This was not typical. When a company accelerates this quickly, it usually means the underlying technology is exceptionally strong or that operational challenges may eventually appear later in the commercialization process. Across early programs, more than 700 patients were treated, including over 100 lung cancer patients. Response rates in melanoma were strong enough that investors began viewing TIL therapy as a potential new foundation for treating difficult solid tumors. Everything changed on February 16th of 2024. The United States Food and Drug Administration granted accelerated approval to lifileucel, later branded as Amtagvi, for adults with unresectable or metastatic melanoma. Accelerated approval is rare on its own, relying on surrogate endpoints rather than survival data. But the more historic fact was that Amtagvi became the first T-cell therapy ever approved for any solid tumor cancer. For decades, experts believed T-cell therapies worked best in blood cancers, not solid tumors. Amtagvi broke that assumption. Investor reaction was exactly what you would expect after a historic first in oncology. The stock surged. Analysts issued optimistic targets. Health Canada approved the product in 2025. That same year, Iovance reported roughly $164 million in revenue, up from just over $1 million the year before. Losses around $370 million did not worry investors, because this level of burn is normal when launching a personalized cell therapy with high manufacturing costs. But then small irregularities began. Treatment center activation, which usually follows a predictable sequence of contracting, training, verification, and patient scheduling, progressed more slowly than expected. For typical oncology drugs, these steps happen quickly since clinics already know how to administer them. But Amtagvi has strict logistics, tight timing, and specialized workflow requirements. Delays at this stage suggested commercialization would not be as smooth as early expectations implied. The narrative cracked on May 8th of 2025. Iovance reported roughly $44 million in Amtagvi revenue for the first quarter and around $49 million in total. Then came the shock. The company cut its full-year revenue guidance from roughly $450 million to a range of roughly $250 to $300 million. A guidance cut of this magnitude is extremely rare unless core commercial assumptions have failed. The company said patient drop-off rates were higher, referral to infusion timelines were longer, and treatment centers were slower to activate than predicted. Individually, these issues are believable. Together, they signal a deeper structural challenge. On May 9th, the stock collapsed by nearly half. That one day became the emotional turning point for the entire investment community. The narrative shifted instantly from scientific triumph to operational risk. In the following weeks, multiple law firms announced securities class action suits. They alleged that between May 9th of 2024 and May 8th of 2025, the company overstated commercial readiness. Lawsuits like this are not typical for companies that have just achieved a historic approval. Their appearance suggested that the gap between what investors expected and what actually happened was too wide to dismiss as routine volatility. Then the chief financial officer, Jean-Marc Belleman, resigned effective July 10th of 2025. Executive departures are common in scaling biotech companies, but when a CFO resigns shortly after a dramatic guidance cut, it is not typical, and investors often interpret this timing as a sign of internal disagreement or strategic recalibration. Yet something unexpected happened. In the second quarter of 2025, the company reported roughly $60 million in revenue, including about $54 million from Amtagvi alone, and more than 100 patients treated during the quarter. This meant demand had not disappeared. The earlier slowdown did not reflect a loss of clinical relevance, but rather operational friction. The company also reduced more than 200 employees and extended its cash runway into the fourth quarter of 2026. Workforce reductions during a revenue growth period are not typical and signaled that the company recognized its original cost structure assumed a faster expansion than reality could support. As this played out, the stock began stabilizing near roughly $2.2. Support formed around $2.2 to $2.4. Resistance appeared at roughly $2.8 to $3. The relative strength index moved near neutral, reflecting a market waiting for clarity rather than reacting blindly. Today, Iovance stands in a delicate middle zone. The science is real. Real-world data show response rates around 49% and around 61% for earlier line patients. Approvals in the United States and Canada provide long-term regulatory foundation. Revenue is growing, but the memory of the May guidance cut, the ongoing legal scrutiny, and lingering questions about scalability continue to restrain valuation. Near-term movement depends on maintaining support above $2.2 and testing the $2.8 to $3 resistance. Consistent revenue progress without legal surprises supports upside. A fall below $2.1 risks a retest of the $1.6 zone. Medium-term momentum depends on operational improvements. Faster treatment center throughput, lower patient drop-off, and shorter referral to infusion timelines could push valuation toward $4 to $5. Long-term value depends entirely on whether Amtagvi becomes more than a melanoma product. If it expands into lung cancer or head and neck cancer, the total addressable market shifts dramatically, and the stock gains a plausible path back toward analyst expectations near $10. Before we conclude, for those watching, listening, subscribing, liking, commenting, and sharing these deep dive episodes, thank you. You are the reason this content keeps getting better, and I will continue to bring you the most rigorous and narrative-driven analysis possible. This was ValueStir.